January 20th, 2026. Gold surges 3% before markets even open. Silver explodes 7.5%. But here's what the financial media won't tell you. In Dubai, physical silver trades at $127 per ounce. In New York, the COMEX shows $73, a $54 gap that should not exist. In Shanghai, the premium widens to nearly $10, the largest disconnect in recorded history. And the arbitrage mechanism that kept East and West balanced for decades has stopped working. Something fundamental has broken in the global silver market. Industrial buyers are scrambling. COMEX deliveries hit 6 times historical levels, and retired Swiss banker Clive Thompson says 4 words that should terrify every portfolio manager. Something has to happen. On January 20th, 2026, gold opened 3% higher before most traders had finished their morning coffee. Silver surged 7.5% in pre-market trading. These numbers alone would have made headlines in normal circumstances, but what unfolded that day was anything but normal. In the physical markets of Dubai, silver bullion traded at $127 per ounce. In New York, the COMEX futures exchange showed $73 per ounce, a $54 gap between physical metal and paper contracts. This was not a glitch. This was not a temporary dislocation. This was a structural fracture in a market that had operated on predictable arbitrage mechanisms for decades. Clive Thompson sat in his Swiss office that morning, reviewing the numbers with the calm precision of a man who had spent 47 years navigating international banking systems. Retired now, but still deeply embedded in precious metals analysis, Thompson understood what these figures meant. He had seen dislocations before. Small ones, predictable ones. Gaps of 50 cents to perhaps $1.50 between Shanghai and New York futures prices. Those were normal. Those could be explained by shipping costs, timing differences, regional demand variations. But this was different. The Shanghai premium had widened to nearly $10 above COMEX pricing. Just weeks earlier, a $5 to $6 gap had shocked analysts. Everyone assumed the arbitrage traders would step in. They always did. That was the mechanism that kept global markets synchronized. Buy cheap in New York, sell expensive in Shanghai, collect the difference, repeat until the gap closes. Simple, efficient, reliable. Except the gap wasn't closing, it was widening. Thompson's analysis was straightforward. If physical silver could be shipped from New York to Shanghai overnight, and if a trader could collect an extra $5, then $10 per ounce simply by moving metal between markets, why wasn't it happening? The answer was equally straightforward and far more troubling. The metal wasn't available to ship. This wasn't about price anymore. This was about availability. The financial media focused on the percentage gains, up 3%, up 7.5%. Bullish momentum, technical breakouts, the usual narrative. But they missed the fundamental story. The story wasn't about prices going up. The story was about 2 separate markets that should have been connected, suddenly operating in completely different realities. Physical buyers in the Middle East and Asia were paying $127 because that was what it cost to actually acquire metal. Paper traders in New York were exchanging contracts at $73 because they were trading promises, not bullion. And somewhere between those 2 numbers was a truth that most market participants hadn't yet grasped. Thompson had been studying precious metals since the 1970s. He remembered the Hunt brothers saga in the 1980s, when aggressive silver accumulation forced COMEX to change its rules mid-game. He remembered Berkshire Hathaway's quiet silver position decades later, and the careful statement they released when it became clear that counterparties might not be able to deliver. He recognized the pattern. When concentrated demand meets limited supply in a market this small, something breaks. Industrial consumers were beginning to understand this reality. For an electronics manufacturer, silver represents a tiny fraction of total production costs. But if the production line stops because silver isn't available, the entire operation halts. Cars don't get built, solar panels don't get manufactured, circuit boards don't get produced. The cost of silver becomes irrelevant when the alternative is zero revenue. Thompson's assessment, delivered in the understated tone of a Swiss banker, contained 4 words that should have triggered alarm bells across every institutional portfolio. Something has to happen. Not might happen, not could happen, has to happen. Because markets don't sustain $54 gaps between physical and paper indefinitely. Because arbitrage mechanisms don't simply stop functioning without cause. Because when buyers in one market are paying 74% more than the quoted futures price, the system has already broken. The question isn't whether something will happen. The question is what form that something will take and who will be positioned correctly when it does. The January 20th price action wasn't a rally, it was a warning. The gap between Dubai and New York wasn't a trading opportunity. It was evidence of a supply crisis that had been building for 5 years, hidden beneath the surface of seemingly normal market operations. And Clive Thompson, with 47 years of experience, watching how financial systems respond to stress, knew exactly what comes next when the gap between paper promises and physical reality becomes too wide to ignore. The countdown had already begun. The price disconnect visible on January 20th, 2026 didn't appear overnight. The foundation for this crisis was laid half a decade earlier, when a critical threshold was crossed that most analysts failed to notice. Somewhere around 2020 or 2021, global mine supply of silver fell below industrial demand. Not by a small margin, not temporarily, permanently, and the gap had been widening every year since. Industrial demand came from three primary sectors. Electronics manufacturing consumed silver for conductivity applications that had no viable substitute at scale. Solar panel production required silver for photovoltaic cells, with demand accelerating as renewable energy mandates expanded globally. Automotive manufacturers needed silver for increasingly complex electrical systems in both traditional and electric vehicles. Each sector's demand grew annually. Each sector operated on just-in-time inventory systems. Each sector treated silver as an input cost so small it barely registered in financial models. Mine supply, meanwhile, remained essentially static. In some years, it declined slightly. Occasionally, it ticked up by a percentage point or two, but the fundamental constraint couldn't be overcome. Silver mining doesn't respond to price signals the way other commodities do. Approximately 70% of silver production comes as a byproduct of other mining operations: zinc mines, lead mines, copper operations. The silver comes out of the ground whether miners want it or not, in ratios determined by geology, not economics. When copper prices rise, copper production might increase, and silver production rises as a consequence. But a higher silver price alone doesn't trigger new supply. The economics don't work that way. For the 30% of production from primary silver mines, the timeline problem was equally insurmountable. From discovery to production, a silver mine requires 5 to 10 years: exploration, permitting, environmental reviews, infrastructure development, capital raising, equipment procurement. By the time a mining company responds to a price signal, the market has often moved on. Or in this case, the crisis has already arrived. So the gap between consumption and production was met by above-ground inventories, decades of accumulated silver, old holdings, inherited positions, bars sitting in vaults waiting for prices to rise. And for the first few years, this system worked. Prices climbed modestly. Holders sold into the rising market. Industrial demand was satisfied. The shortfall was covered. But seller behavior follows predictable patterns. The first sellers are always the weakest holders, the ones Thompson called paper hands in his analysis. Silver rises $5 and they exit. They've been waiting for any gain and they take it immediately. These sellers flooded the market in 2021 and 2022, creating the illusion that supply was ample. The second wave holds longer. They've seen the price rise $5 and they didn't sell. When it rises another 10, they start to question whether they should have sold earlier. Some exit, some hold. The supply continues, but at a slower pace. By 2024 and 2025, the market was dealing with the third category, the diamond hands, as Thompson termed them. These holders had watched silver rise $20, $30, $40. They hadn't sold at 5. They hadn't sold at 20. They weren't selling now. And each price increase made them more convinced they were correct to hold. The psychology had shifted from a take profit to this is going much higher. The result was predictable. Industrial buyers who had always been able to source silver at predictable prices were suddenly discovering that physical metal was harder to acquire. Not impossible, but harder. Lead times extended. Premiums widened. Suppliers became selective about which customers received priority. Then the COMEX delivery data began telling a different story. In January 2024, physical delivery requests were already elevated compared to historical norms. In January 2025, deliveries doubled. Market observers noted the anomaly, but assumed it was temporary. Perhaps a single large buyer, perhaps a short-term supply chain issue. January 2026 changed that assessment. Deliveries tripled compared to January 2025, which meant they were running at 6 times the level seen just 2 years earlier. This wasn't one buyer. This wasn't temporary. This was a fundamental shift in market behavior. Someone, or more likely multiple entities, were standing for delivery instead of rolling contracts forward. This violated the basic assumption of futures markets. Futures exist to transfer price risk, not to facilitate physical delivery. Most contracts get rolled indefinitely. Traders maintain positions without ever intending to take possession of the underlying commodity. But that system only works when participants trust they could take delivery if they wanted to. When that trust erodes, behavior changes, and the delivery data suggested trust was eroding rapidly. Thompson recognized the pattern from historical precedents. In the 1980s, the Hunt brothers had disrupted silver markets by doing exactly this: taking delivery, accumulating physical metal, refusing to roll contracts. The exchange response was swift and brutal. New rules were implemented. Silver Rule number 7 prohibited using borrowed money to take delivery. Position limits were imposed on contract rollovers. The Hunt brothers were effectively forced into cash settlement, unable to take delivery or roll forward. Decades later, Berkshire Hathaway accumulated a substantial silver position. When delivery questions arose, Berkshire issued a carefully worded statement indicating they understood some counterparties might need additional time to deliver. Translation? The metal wasn't readily available, and Berkshire was giving the market breathing room to avoid a default scenario. Now, in 2026, the delivery surge was happening again. But this time, the buyers were likely industrial consumers, not speculators. Companies that needed physical silver for production lines. Companies that had run the calculations and realized that paying any premium was cheaper than shutting down manufacturing operations. For these buyers, price sensitivity didn't exist. Silver might represent 0.5% of the cost of a solar panel, 0.1% of the cost of an automobile. But without it, the production line stops. Revenue goes to zero. The calculation was simple. Pay whatever is necessary to secure supply. The COMEX responded as exchanges always do when stress appears. In late 2025, margin requirements were adjusted. Thompson watched these developments with the detached analysis of someone who had seen the sequence before. Exchanges don't change rules when markets are functioning normally. They change rules when something is breaking. And the rule changes in late 2025 and early 2026 indicated that something fundamental was breaking in the silver market. The 5-year supply deficit had depleted the buffer of above-ground inventories. The psychology of holders had shifted from selling into strength to holding for much higher prices. Industrial demand continued growing regardless of price. And the arbitrage mechanism that should have kept global prices synchronized had stopped functioning because physical metal couldn't be moved from west to east at any price. This wasn't a temporary dislocation. This was a structural supply crisis. In Clive Thompson's assessment, something has to happen. It wasn't speculation. It was recognition that markets don't sustain this level of stress indefinitely without a resolution. The only question was what form that resolution would take. While silver's supply crisis unfolded in industrial markets, a parallel transformation was occurring in institutional portfolios. The actors were different. The timeline was different. But the fundamental driver was identical. Recognition that the existing monetary system had entered its terminal phase. Central banks were leading the shift, though not through public announcements or policy statements. The evidence appeared in their quarterly reserve reports. Non-aligned nations, particularly those outside the traditional Western sphere, were systematically reducing their reinvestment in U.S. treasuries and European sovereign debt, not selling existing positions, which would be viewed as hostile, simply allowing maturing bonds to settle and redirecting that capital into gold. The mathematics were straightforward. Government debt globally was growing at 6% to 7% annually. This wasn't a projection. This was measured reality across developed economies. Meanwhile, tax revenues were growing at 2% to 3% in strong years. The gap between debt growth and revenue growth was widening, not narrowing. And the interest cost on that expanding debt was consuming an ever larger share of national budgets. Japan provided the clearest preview of what comes next. With a debt-to-GDP ratio exceeding 260%, Japan had operated for years under the assumption that near zero interest rates were permanent. That assumption was now collapsing. Short-term rates had risen above 2.3% by early 2026. Each fractional increase in rates translated directly into higher interest costs on rolling debt. Bonds issued a decade earlier at 0.25% were maturing and being refinanced at rates 10 times higher. The mathematics were unforgiving. At some point, interest costs exceed total tax revenue. When that threshold is crossed, governments face 3 options. Default, which destroys credibility and access to future borrowing. Austerity, which is politically impossible in democracies. Or monetary reset, which wipes the slate clean through some combination of currency revaluation, debt jubilee, or forced conversion into new monetary instruments. Central banks in emerging markets were running this calculation and reaching the same conclusion. The current system was mathematically unsustainable. The question wasn't whether a reset would occur, but when and in what form. And when that reset arrives, the only assets with guaranteed value are those outside the financial system. Real estate, commodities, and most liquid of all, gold. So the pattern in reserve accumulation was clear. Treasuries declining as a percentage of total reserves. Gold increasing, not through dramatic sell-offs that would trigger diplomatic incidents, but through patient, systematic reallocation over years. The gold was being acquired quietly, often through Shanghai markets to avoid impacting London or New York prices visibly. Western institutional investors were slower to recognize the shift, but recognition was accelerating. Wealth managers who had ignored precious metals for decades were reviewing the data and reaching uncomfortable conclusions. A portfolio containing even a small allocation to gold, 3% to 5%, would have outperformed a traditional 60-40 stock bond portfolio over the previous 5 years, not just in absolute returns, but in risk-adjusted returns. This metric, known as the Sharpe ratio in institutional analysis, measures return per unit of volatility. A higher Sharpe ratio means better returns with less fluctuation, and gold, contrary to its reputation as a volatile speculative asset, had actually reduced portfolio volatility while improving returns. This wasn't theory, this was measurable historical performance. Thompson's conversations with wealth managers confirmed what the data showed. Those who had allocated to gold in 2024 or early 2025 were pleased with results, but regretted the allocation hadn't been larger. Those who had ignored gold entirely were now facing client questions about why the portfolio had underperformed peers, and those questions were driving allocation decisions for 2026. The traditional institutional allocation to gold, common in Swiss private banking through the 1980s, was 5% of total portfolio value. That standard had eroded to less than 1% across most Western portfolios by the 2010s. The mathematics suggested a reversion to historical norms was beginning. If institutional allocations moved from 1% to even 3% over the next 2 years, the demand impact would be substantial. The global gold market, while larger than silver, was still small relative to bond and equity markets. A 2% shift in institutional allocations represented trillions of dollars seeking a market measured in hundreds of billions. This demand couldn't be satisfied through paper gold alone. ETFs and futures contracts worked for trading positions, but institutions seeking actual portfolio protection required physical allocation or fully allocated storage. The trust required for paper promises was eroding in parallel with trust in sovereign debt. Meanwhile, gold mining companies were experiencing a phenomenon that defied traditional market logic. Their profits were surging, yet their stock valuations remained compressed. The leverage effect in gold mining was mathematical. A mining company extracting gold at $2,000 per ounce and selling at $3,000 earns $1,000 profit per ounce. When gold rises 33% to $4,000, the company's extraction cost remains $2,000, but profit doubles to $2,000 per ounce. A 33% increase in gold price generates a 100% increase in profit. This was now showing in quarterly earnings reports across the sector. Every major gold producer reporting results in late 2025 and early 2026 showed higher profits than the previous year, higher profits than the previous quarter. Guidance revisions upward. And yet, price-to-earnings ratios remained below 10 for most companies. Traditional market behavior assigns high valuation multiples to companies with rapidly growing earnings. Technology companies with 20% annual earnings growth routinely trade at PE ratios of 25 or 30. Gold miners showing 50% to 100% earnings growth were trading at ratios below 10. The disconnect suggested the market hadn't yet priced in the sustainability of higher gold prices. Thompson observed a predictable pattern around earnings announcements. When companies reported results, analysts updated their models and raised price targets. Algorithmic trading systems scanned for stocks where target prices exceeded current prices by the largest margins. These systems bought automatically, driving price spikes on announcement days. For investors, this created tactical opportunities. But more importantly, it revealed that institutional recognition of gold mining fundamentals was still in early stages. When that recognition matured and PE ratios normalized to reflect growth rates, valuations had significant room to expand, even if gold prices stabilized. The geopolitical dimension added another layer of urgency to institutional repositioning. The weaponization of the dollar through sanctions and financial system exclusions had forced even allied nations to question their exposure. If the United States could freeze Russian central bank assets or exclude nations from SWIFT payment systems, then any country might face similar action if political winds shifted. This created a fundamental problem for sovereign wealth managers. Their mandate was to preserve national wealth across decades and centuries. But if that wealth existed primarily as digits in Western financial systems, it could be confiscated or frozen with a policy decision. Physical gold, stored in domestic vaults or in neutral jurisdictions like Switzerland or Singapore, couldn't be frozen remotely. The question these institutions were now asking wasn't whether to allocate to gold. That decision was already made. The question was how much, how quickly, and in what form. And each quarter's reserve reports showed the same answer: more, faster, physical. Thompson's assessment of the gold market paralleled his silver analysis, but with one critical difference. Silver faced an industrial supply crisis that would resolve through price destruction of demand or forced substitution. Gold faced a monetary crisis that would resolve through systemic reset. Both were entering terminal phases. Both required something to happen. But the something that happened would take different forms, with different implications for prepared investors. The institutions were positioning. The data was clear. The only question was whether smaller investors would recognize the pattern before the positioning phase ended and the crisis phase began. Markets under stress resolve through one of three pathways. Clive Thompson had observed this pattern across 47 years of banking crises, currency collapses, and commodity dislocations. The precious metals crisis unfolding in 2026 would follow the same template. The only variables were timing and which pathway would be triggered first. Scenario 1 was regulatory intervention. Exchanges don't allow their largest participants to fail. When shorts cannot deliver, when longs demand physical settlement that cannot be satisfied, when the gap between paper contracts and physical reality threatens systemic stability, regulators step in. History provided the blueprint. In March 2022, the London Metal Exchange faced a nickel crisis. A Chinese producer held a massive short position. Nickel prices exploded upward. The short couldn't meet margin calls. Default was imminent. The LME's response was unprecedented. They canceled trades. Buyers who had purchased nickel contracts at lower prices and watched them appreciate substantially were simply told their contracts no longer existed. Cash settlements were imposed at prices that protected the shorts at the expense of the longs. Legal challenges followed, but the immediate crisis was contained by changing the rules mid-game. COMEX had done the same in the 1980s with Silver Rule No. 7, when the Hunt brothers' delivery requests threatened to expose that the exchange couldn't deliver the physical metal backing its contracts. Rules were changed to prevent delivery using borrowed funds and to limit position rollovers. The shorts were protected. The longs were forced into cash settlement. Thompson's analysis suggested similar intervention was likely if delivery pressure continued to build through 2026. The exchange would protect the bullion banks, the large institutions on the short side of contracts. Force majeure clauses might be invoked. Position limits might be imposed retroactively. Cash settlement might be mandated at prices disconnected from physical market reality. For investors holding paper positions, futures contracts, or unallocated metal accounts, this scenario represented total exposure. The contract says you own silver at 73s. The physical market trades at 127s. The exchange settles your position at 85s and declares the matter resolved. You receive cash that cannot purchase the metal you thought you owned. The opportunity is lost. The protection you believed you had evaporates. Scenario 2 was the digital currency transition. Central bank digital currencies were no longer theoretical. Pilot programs were running in over 100 countries. The European Central Bank had committed to a digital euro timeline. The Federal Reserve continued to study implementation despite public denials of imminent launch. China's digital yuan was already operational at scale. The stated rationale was efficiency, transparency, and anti-money laundering enforcement. The unstated reality was control. A CBDC system allows governments to monitor every transaction, impose negative interest rates directly on holdings, restrict purchases to approved categories, and enforce capital controls without requiring bank cooperation. Thompson drew the comparison to rationing coupons in post-war Britain. During that period, possessing money wasn't sufficient to purchase goods. Ration coupons were required. The coupons became more valuable than the currency because they represented actual access to real goods. The money was secondary. A CBDC future created a similar structure. Perhaps citizens would be limited to holding $10,000 or $20,000 in their digital wallet. Amounts above that threshold would be automatically swept into bank accounts, but those bank accounts would be inside the monitored system. Transfers above certain limits might require approval. Purchases of certain asset categories, precious metals for instance, might be restricted or prohibited entirely. In such a system, wealth held inside the financial structure becomes trapped. It exists on ledgers, it shows on statements, but it cannot be deployed without permission. The modern equivalent of having money but no ration coupons. Wealthy on paper, but unable to act. The protection against this scenario was assets outside the system. Physical precious metals in personal possession or in allocated storage where title is clear and withdrawal rights are contractual. Real estate, though subject to property taxes and eminent domain. Tangible goods with enduring value. Anything that exists independent of digital ledgers and centralized control. Scenario 3 was what Thompson termed simply, something has to happen. The mathematical certainty that current debt trajectories were unsustainable. The recognition that interest costs were approaching the point where they would exceed total tax revenue in major economies. When that threshold is crossed, governments face a binary choice. Explicit default, which destroys credibility and future borrowing capacity. Or implicit default through monetary reset. The reset takes many forms historically. Currency revaluation, where old money is exchanged for new money at unfavorable ratios. Debt jubilee, where obligations are partially or fully canceled. Forced conversion of bonds into new instruments with different terms. Wealth taxes on assets above certain thresholds. The common element across all variations is that nominal wealth is destroyed, not through market decline, but through policy decision. Bank deposits might be converted to new currency at 60 cents on the dollar. Bonds might be redeemed at 40% of face value. Wealth taxes might confiscate 30% of assets above defined limits. These aren't theoretical scenarios. Argentina did this multiple times. Russia did it. Greece imposed capital controls and forced debt restructuring. When the mathematics become impossible, politicians choose the path that preserves power while appearing to address the crisis. And that path always involves transferring losses from the government to asset holders. Physical gold and silver survive these transitions because they exist outside the ledger system. A 1-ounce gold coin remains a 1-ounce gold coin regardless of what happens to the currency used to price it. When the reset occurs, precious metals reprice in the new system. They don't get haircut, they don't get converted at unfavorable ratios. They maintain value across the discontinuity. Thompson's guidance for positioning was methodical, not panicked. For individuals with no precious metals exposure, the recommendation was gradual accumulation. Purchase a small position, become comfortable with the decision, add incrementally over months. The goal wasn't speculation or trading profits. The goal was insurance against systemic failure. For those viewing metals as investment rather than insurance, paper positions remained viable if the holder accepted the scenario 1 risk of regulatory intervention. ETFs and futures provided leverage and liquidity, but they also provided counterparty risk and the possibility that contracts would be settled in cash at prices disconnected from physical reality. The premium on physical metal, which could run 15% to 30% above spot prices depending on form and jurisdiction, wasn't a cost in this framework. It was the price of removing counterparty risk, the price of holding an asset that couldn't be confiscated digitally, couldn't be settled at artificial prices, and couldn't be trapped by capital controls. For institutional investors and high net worth individuals, the mining sector offered leveraged exposure with additional complexity. A gold miner extracting at $2,000 and selling at $4,000 generates 100% profit margins that flow to shareholders through dividends or reinvestment. But mining operations carry geopolitical risk, operational risk, and management risk. Thompson's approach to mitigating these risks was geographic diversification. No more than 2 positions in any single jurisdiction. Preference for stable jurisdictions like Canada and Australia, but with selective exposure to higher risk regions like Mexico or West Africa, where potential returns justified the additional risk. Focus on producers near larger companies that might become acquisition targets, as consolidation typically occurs when metal prices are elevated and larger producers seek to replace depleting reserves. The timeline for these scenarios was compressed. Not years, months, perhaps quarters. The delivery pressure at COMEX was accelerating, not stabilizing. The debt mathematics in Japan and Europe were approaching critical thresholds. The CBDC infrastructure was largely built and awaiting deployment triggers. And the gap between physical and paper prices in silver had reached levels that historically preceded either market intervention or system failure. Thompson's 4 words, "something has to happen," weren't prediction. They were mathematical certainty. Systems under this level of stress don't remain in equilibrium. They resolve. The resolution might be orderly or chaotic. It might favor those positioned in physical assets or those holding paper claims. It might occur through regulatory action or through market failure that forces regulatory response. But it would occur. The countdown had begun. And the professionals who understood market history were positioning accordingly, quietly and systematically, while public attention remained focused on percentage gains and technical chart patterns that missed the fundamental story entirely. The question facing every investor, institutional or individual, was no longer whether to prepare. The question was whether preparation would be completed before the scenario selection was made for them.